Hi, I'm John Pasalis, and this is the Move Smartly Show. In today's episode, I'm going to be speaking with Ben Rabidoux, housing analyst at Edge Realty Analytics, firm that specializes in analyzing Canada's housing market and the broader economic trends in Canada. We've had Ben on the show before. I wanted to invite him back to get his insight and feedback on what he's seeing on the ground in the market. Ben's one of these people who's very dialed into what is happening, not just in the economic data, but also what is happening on the ground. He frequently speaks with industry people, including myself, real estate brokers, mortgage brokers, to understand sort of the on-the-ground trends across Canada. So he's very dialed in. So I wanted to get his feedback. He's expecting that the economy is doing a lot worse than the markets are predicting. So he's expecting more rate cuts than the market predicts. We're going to talk about his thoughts on Canada's declining population growth rate and declining housing starts and how all of that is going to feed into the economy and into the housing market. As always, if you have any questions, you can always send me an email at askjohn@movesmartly.com. And now on to today's show. All right, Ben, thanks again for joining us for this week's Move Smartly video and podcast. Thanks again for taking the time.
Yeah, good to see you, John.
All right, very good. So we're going to dive in and have like I said, a bit of a macro discussion, get some of your thoughts. For the people in the real estate industry on the show who don't know, Ben publishes a great report for the real estate industry. There's a company called Edge Analytics, monthly reports with in-depth analysis. And I mean, I subscribe. I think quite a few people in the industry that subscribe to it, to get their kind of macro take. So thanks for publishing that kind of great content out for all of us.
Hey, thanks for the kind words.
Yeah. So we had a bit of a kind of positive look at sort of inflation last week. Next week, the Bank of Canada's rate announcements coming up. What are you seeing now with the latest inflation numbers? Are you thinking they're going to continue to pause? Do you think we're going to start to see some cuts happening?
Yeah, so I've been on record for a while now saying that I believe that the Canadian economy is starting to show signs of weakness that maybe aren't fully being appreciated by policymakers, including the Bank of Canada. Mm-hmm. Now, that view kind of took a bit of a hit when we had the monster job report last month that was, or when I say last month, earlier this month, where it was, 90,000 jobs created. Mm-hmm. And that was a bit unexpected. You always have to be careful. That particular data is a household survey, so it's a lot of picking up the phone, calling people, hey, are you unemployed? And a lot of times the last thing somebody wants to do when they just lost their job is talk to Stats Canada about it. So you get these really volatile readings. And at the same time, if you wait another few weeks, you get the payroll data. Yeah. And the payroll data draws from actual payroll remittance from businesses. And so it's a much better quality data source. Mm-hmm. And so all that to say is I want to wait and see what that looks like before I kind of put too much weight on this idea that Canada created this monster number of jobs in April. I'm a little suspicious that that's not true. Right. But to get back to your original question, so what am I thinking on rates front? I do think that the Bank of Canada is going to have to cut much more than the markets broadly expect right now. And so I think the June meeting is up in the air. I think markets right now are putting it effectively a coin toss. Like I think they're probably going to cut. Maybe 60-70% chance that they cut. And the reason being that, as you said, the inflation stuff looks really positive, right? So headline inflation 2.7%. Like, okay, that's not really what drives the needle for the Bank of Canada. They're looking at core inflation measures. All the core inflation measures are slowing quite sharply. And if you look at, for example, the 3-month change in core CPI, it's annualizing at 1%. It has been for the last few months. Mm-hmm. So there's really not a lot of inflationary pressures there at the moment. Now, of course, that can always change, but a snapshot, the inflation fight effectively is, it's a past issue.
So maybe can you unpack what you mean by the core CPI?
Sure.
Just for the listeners and.
Yeah, absolutely. So within the inflation data, the headline number that gets all the press. So when you see CBC running an article about inflation 2.7% in April, that's the headline number. Now that includes some components that are super volatile, particularly gasoline. And everybody knows you fill up your tank, the price jumps from one week to the next, or it falls one week from the next. And if you're a policymaker trying to set inflation or trying to set interest rates based on that sort of data, like it's just bouncing around constantly. And so often what they will do is they'll strip out those super volatile components and they'll look at the underlying trend in the more stable components. And so so the Bank of Canada has a mandate to keep inflation within like a 1% to 3% band. And in particular, they're focusing on core inflation. Now, I just want to really comment really quickly because in Canada, unlike most other countries, we include mortgage interest costs within the CPI basket, which is really a strange way to think about it because that sets up a situation where if inflation starts to run hot, the only policy that the Bank of Canada has is to raise rates. Now, when they do that, that in turn jacks up mortgage rates, and that feeds back into this inflationary dynamic. And that's not a small thing right now. Like right now, mortgage interest costs are adding, depending on the month, kind of 0.6 to 0.7 percentage points of that headline reading. If you back that out, we find that inflation has been at bang on 2% for the last 5 months. So again, I think the inflation fight is done. I think that there's enough tentative signs for the Bank of Canada to see that the economy is beginning to soften, the labor market softening. Certainly, we're seeing business insolvencies, pretty alarming increase there. So there's signs that businesses are starting to really hurt. And I think they are going to start cutting likely in June. I've had a view for a while now that by late summer, maybe into the fall, we're probably going to have like an oh crap moment in Canada where the numbers, the economy starts to really soften. And I've made the argument I wouldn't, short-term forecasting in the economy was really tough, but I wouldn't be surprised if by the end of the year, the conversation goes from do we need to cut to will 25 basis points of cuts at a time be enough? I think that's where we're going. I think the economy is going to cool very quickly.
Yeah, I think, and I read your reports. I mean, I think as you mentioned, you're expecting way more cuts than the market's kind of predicting, and the market's only predicting what, 2 or 3 this year.
Right now it's 2, and it's only a cumulative 100 basis points over the next year, which I think is really low. Yeah, I think it's going to be significantly more cuts than that.
So how low can the Bank of Canada go, given what's going on in the US? Like, can we really go that much lower than what the Fed's doing in the US?
Yeah, that is the great question, and that's going to ultimately be the constraint on the Bank of Canada. Because you're right, if they cut too quickly and too much, and the US Federal Reserve stays as tight with their monetary policy as they are, then it gets vented through a much weaker currency. And if you let that get too out of hand, that in turn starts to stoke inflation because now you're having to pay more to bring imports in. And so the Bank of Canada has a real tight wire act to walk. I 100% agree that if the US Fed does not start to move, there is a limit to how low the Bank of Canada can go. I don't think that's a discussion certainly not for this year, and potentially not even for 2025. I think that's more a discussion. I think the immediate concern is going to be that I think we are underestimating the impact of these high rates and how significantly it's going to start to hurt the economy. And so they're going to start cutting. I could see them getting 200 basis points of cuts in before they have to start really addressing the weakening currency. And by the way, I've been of the view that in this cycle, the Canadian dollar is going to retest the lows from the early 2000s when it got down to kind of 62, 63 cents versus the US dollar. I think that's where we're going.
Interesting. And do you think the pressure on the economy is largely stemming from households, like just household spending's kind of pulling back? And to what extent, like we had a couple of announcements recently which I thought were interesting because they seemed like a bit contradictory. The Bank of Canada was kind of confident households can manage these upcoming rate increase over the next 2 years. OSFI, which is the bank regulator, seemed a little bit more concerned. So what are you kind of seeing on that front? Like, do you think this is going to kind of weigh on household spending, household consumption as we start to get more people renewing at 5+% on their mortgages?
Yeah, of course it will. I mean, there's no other. And look, they can both be right? Like, so OSFI can look at this data and say, this is going to be a real problem if the Bank of Canada doesn't cut, right? And they are 100% right. It's going to be a huge problem. I'll outline how big a problem in a moment. But the Bank of Canada can also say, we think it's going to be manageable, because in the back of the mind, they know that they're not going to be renewing at these rates.
Mm-hmm.
Right. So they understand that, yeah, like they can't hold rates here. It will be a real problem. And so they're going to have to cut.
Mm-hmm.
Now, just to frame it. So you're right. If we look at the kind of the run rate of originations, we've got 2024, relatively light year for originations. Top of my head, call it 15% of the mortgage market churns over. Next year it jumps to 25%, and then it's more almost 35% in 26. So you've got
Mm-hmm.
two really heavy years of renewals coming up.
Mm-hmm.
And if you look at the change in payments that are on deck, based on where rates are currently, on a median basis, the change in payments is going to be around 30% come 25, 26.
Mm-hmm.
But if instead you look at the really vulnerable cohort, which is these static payment variable products,
Mm-hmm.
those payments are set to be 50 to 60% higher, median.
Mm-hmm.
So you got half of the Canadians are going to have an even higher, or half of those particular mortgage borrowers are going to have even higher payments than that. Now, that's not a small number of the mortgage market. OSFI estimated at 15%. I think it's higher. By my math, it's over 20% of mortgage borrowers.
Mm-hmm.
And so, and it could be as high as 22, 23%. So almost a quarter. And I can walk through that math, why I disagree with OSFI, but it's me versus OSFI on this particular one. But it's a lot, right? Like if you say 20% of the mortgage holders in the country are facing 50 to 60% monthly payment increases,
Mm-hmm.
that's not manageable. Like it's not. And so it's going to get vetted through weaker consumption. It's going to get vetted through, people having to default on various credit products, ultimately filtering through to higher defaults on mortgages too. But I think all of that looks really recessionary.
But how much, I mean, out of curiosity, how much of that do you think is going to impact just a small segment of those renewing, like the people who bought recently? Like anyone who's renewing, who's owned their home for 10 years, can probably just refinance, extend their amortization, which is kind of what people have been doing to soften that payment shock. And is that something that you think is going to happen, that might kind of obviously offset some of this pressure we're seeing from rates?
I don't think there's a way to offset it at all. Like you've got people that are renewing that have these are static payment variables. So they went in with a 1.5% mortgage back in 2021.
Yeah. But what I'm
What do
saying
you
is
change to? Yeah.
but if they've owned their home for 10, 15 years, and they're about to renew at a 15-year AM because they're on a 25-year schedule, I guess my question is, in theory, they can just extend their amortization, right? To solve.
Listen.
That's more of what I mean.
Yeah. Okay. Of course. When I say that 20% of the mortgage market is going to be facing payment shock, 50 to 60%, that's not in any way meant to imply that 20% of the mortgage market is going to default.
Yeah.
Of course, it's going to be some smaller component of that for exactly the reason you outlined. And frankly, there's plenty of Canadians that have the capacity to absorb those payment increases regardless. So I'm not for a moment saying we've got like that. But let's also be clear here. Mortgage delinquencies today are 17 basis points. That is still half of the long-term norm. Now, let's think this through. In an era where we have just seen the steepest rate hiking cycle in 30 years into a very levered household sector, will mortgage delinquencies at least get back to average? Like, of course they will. They're probably going to go substantially above average. So mortgage delinquencies could easily triple from here. And I think that's a reasonable way to think about it. And that's not even that alarming. A tripling from here into 50 basis points is not, that's not the end of the world, but it's material pain for a non-trivial portion of homeowners.
Interesting. So that's super helpful. I mean, in terms of kind of the macro outlook. Now, one thing I wanted to kind of pivot on and chat about, and it's something that you I think we're one of the first people to really kind of highlight, was that this Fed's shift and sort of non-permanent residents. And you were kind of one of the first ones to kind of talk about what this means and what this might mean for population growth. So maybe can you kind of unpack what you found? And I know kind of the Bank of Canada had very similar numbers that you had reported. And then, of course, the magic question was, is it actually going to happen? Right. So maybe you kind of walk us through what those numbers are relative to where we are today. And then, your thoughts on if the Fed's actually going to follow through with this.
Sure. This is the big story to watch in housing in the next couple of years. So if you go back to, I think it was 2021, maybe, I was testifying before Parliament on this exact issue. And it's funny because back then the numbers were so much smaller. And even then I was like, this is a real problem. You guys got to really, you know what I mean?
Mhm.
And back then we were talking about seeing the non-permanent resident cohort growing by 200,000 a year. And today it's 800,000. So just to unpack that. So non-permanent residents are international students, they're temporary workers, and then they're what we call asylum seekers, so refugees, et cetera. And so I think most Canadians understand that we have like a cap on permanent residents of a little under 500,000 admissions every year. And by and large, I think Canadians are supportive of that particular component of immigration. And so, you bring in 500,000, we lose 50,000 that go to other countries. So on net, you're typically adding 450,000 on a permanent basis. Okay, so that's generally what those numbers have looked like over the last couple of years. Now, you fast forward to today, and the population has grown by 1.3 million in the past year. So how do you go from a run rate of 450 up to 1.3? And the answer is you've seen this huge surge in this non-permanent resident cohort, overwhelmingly international students and temporary workers. Now, some of that was related to just tightness in the labor market, but a lot of it is related to just irresponsible policies by post-secondary institutions in Canada that realize that they can charge international students 5 times the tuition. And so, and not only that, but then you had these for-profit colleges, and I'm going to use that term very loosely, where it's like some sketchy shop set up in a greasy plaza somewhere, and they could hire recruiters to go over to other countries, primarily India, and make all these promises around, hey, if you send your kid here, then they'll be fast tracked for permanent residency, and then once they get that, then through the reunification visa, you guys can all come here. And they made all these outlandish promises. Now, because of that, we've seen this huge surge in non-permanent residents to the point where it's beginning to cause, or it has been for the last couple of years, been causing a lot of issues, particularly in the rental market, because non-permanent residents are renters, right? International students, temporary workers, they're all renters. So the easiest way to think about it is if you throw 800,000 renters into the Canadian population in a year, like, of course you're going to have a crazy, chaotic rental market, right? And that in turn has fed through to inflation and forced interest rates higher. Like, it's had all these knock-on effects. I hate to oversimplify things, but I am very much of the view that a lot of the problems that we are seeing in Canada today, and a lot of the frustrations people have around cost of living and access to healthcare and access to shelter, is all tied up in this one issue. And had we not seen this sort of irresponsible growth in this cohort, things would look very different in Canada. So now we're at the point where Canadians are realizing that this has been a policy failure. The federal government is recognizing they're getting decimated in the polls. And so they have to act. And so what they've decided is they have rightfully recognized that this is the issue. They have to tighten up around non-permanent residents. And so the specifics around what they announced is that in the next 3 years, they want to get the non-permanent resident cohort down to 5% of the total Canadian population from about 6.5% currently. So the simple math that I did, the moment they announced this, my brain went, holy cow, this is a big deal, and no one's recognizing how big a deal this is. So I did the numbers. If you assume that permanent resident growth continues at the same pace, in order to get the non-permanent resident down to 5% of the total population, it would imply that you have to reduce that cohort by 600,000 over 3 years. And so that was the numbers that I did. So now, if that's all that you know, that let's just assume really simplistically that they're going to do 200,000 over the next every year over the next 3 years, okay, or 200,000 reduction. Then right away you go from adding 800,000 to the population to subtracting 200,000. So it's a 1 million net swing in the contribution of that cohort to population growth, which right off the bat would imply that population is going to slow from 1.3 million down to something closer to 300. So I put those numbers out. I took a ton of flack over it. But you roll it forward a month later, and the Bank of Canada, in one of their monetary policy reports, had the identical chart to what I had put out. And so that's where we're going. But you rightly pointed out that this is contingent on the government actually following through. They have not given us the specifics around how they're going to accomplish this.
Mhm.
But at this point, I have to give them the benefit of the doubt, because if you look at the polls and where they're getting hammered, it is around this exact issue.
Mhm.
And so if they have any hope of winning the next election, I think they have to do this. And
Mhm.
so I have no reason to doubt them. I don't know the specifics of what it's going to look like, but those, those are the numbers. That's where we're
Yeah.
at.
I mean, and just to unpack that, I mean, that's a huge, I mean, I don't know if a lot of people really appreciate this. Like you said, I mean, it's a big difference. I mean, rents have been booming, the market's been moving. If you think about, we're adding an additional, over and above our immigration, 800,000 renters per year.
It's
Okay.
crazy.
That is like, it's an increase of 800,000 people per year. And we're going from increasing 800,000 to actually reducing the rental demand by 200,000 people per year. How is that going to play out in the rental markets? And I think we have rents are declining, at least in Toronto. We have record number of condos kind of under construction and scheduled for completion. To what, how is this going to play out, do you think, in the condominium space in the GTA?
Yeah, it's a great question. So my view on condos is I don't know how much demand for rental condos is coming from that cohort, because it tends to be the more expensive portion of the market.
Mm-hmm.
I think what we're seeing, because you're right, the condo market is seeing declining rents.
Mm-hmm.
To me, that's much more indicative of just we've seen an acceleration in completions in
Mm-hmm.
2024. And I think what we're seeing is a lot of the units that were purchased in 21, 22, 23 were bought by, well, not so much 23, but let's say 20, 21, 22 were bought by investors. And now those are completing. They maybe had hoped to assign it to an end user. They can't really assign it. So now they're being forced to close.
Mm-hmm.
They don't really want to sell it at a loss, so they're renting it. And you've had this surge in rental listings. We've seen rental listings up about 50% year over year to start the year. And so that has kind of swamped demand, and you're seeing downward pressure in the rental space, in the condo rental space specifically.
Mm-hmm.
You get out to purpose-built rentals that are maybe, tend to skew a little more affordable. We're not seeing that same decline, but we are starting to see some softness, some less dramatic increases, let's say that. And I think that's going to be the story really between now and 26 is a much more normal, subdued rental market as these, again, if the feds follow through, you're going to see a much more subdued rental market, because not only are you going to be flat out reducing rental demand, which is crazy. I don't know the last time we've seen a reduction in rental demand, but there's also a lot of both purpose-built and condos under construction across the country, and purpose-built rentals, that is, and so as those complete in the next couple of years, there will be a pretty decent flow of new supply. I think you're going to see rents drop, like rental growth go from kind of 8 to 10% currently, and down to like 1, 2, 3%, which is a way more normal market. I think you're going to see vacancies nationally, which right now are at record lows of about, I think it's like 1.2 or something. It's very, very low. And they're going to go back to average or maybe slightly above average over the next couple of years, which is like 3.5%. Totally normal market. I'm not alarmed. I'm not like worried. I'm not predicting that rents are going to collapse or anything. We're just going to go from crazy rental market to something that's been like more than long-term norm. That's all I'm calling for.
So if the condo market's not going to get hit as much, because I agree with you, it is obviously kind of the higher end of the rental market. What segment do you think might get hit a little bit more by this pullback in non-permanent residents? Is it kind of the investors who bought these suburban homes and are renting them out as rooming houses that are going to have
exactly it.
Yeah.
You got it. You bang on. So I would say there are regions where I can identify what appears to me to be a potential short-term overbuilding in supply. And so, a lot of parts of BC look, I mean, there's a lot under construction, especially relative to existing rental stocks. I mean, I could see some scenarios where you see some downward pressure on rents there, but broadly, the segments that I'd be worried about would be exactly what you identify, which is, I bought a single family home as an investment. I can't cash flow it by renting it to a family, but I can cash flow it by renting it to 12 college kids, charging them $500 each. To me, that's a dangerous proposition going forward, especially since, and this is really important, the one policy that we have heard from the government around cooling non-permanent resident growth is that they are planning on reducing the number of study permits issued next academic year by 35% relative to 2023 levels. Okay, that's nationally. But then the second thing they announced, and this is really important, is they're then going to allocate those permits on a per capita basis. What that means is nationally, you're going to have a 35% decline. But in Ontario, it's going to be a 60% decline. And in BC, it's going to be almost a 60% decline. So if you're slowing the flow of students by 60% next year, and the overall goal is to reduce those numbers over the next few years, like, man, I just wouldn't want to be sitting on a home where I had to jam it full of 12 students to make a return. Like, to me, that just looks like a really precarious situation.
Yeah, it's kind of interesting you say that, because I mean, we're kind of seeing it even in the condo market right now. Like, a lot of course, investors bought having a hard time renting because the rental market's so slow. And yeah, I suspect I wouldn't be surprised if that kind of plays out next year in these low-rise suburban homes and people just can't fill them with enough students.
Yeah. Hey, John, let me ask you, if you don't mind if I turn this around on you for a second, but what do you think is driving, like, when you say the rental market is slow, is that a function of just a lot of new supply, or are you seeing that the demand for rentals is actually declining too?
No, I think it's the surge in completions, quite frankly, because if you actually look at it, it's like, yeah, I'm on your page. Like, the demand, I don't think the demand's necessarily growing. Like, I think the demand is still there, but it's largely just a ton of stuff that hit the market, right? And when you have so many completions hit the market at the same time, everyone has options. There's a lot to look at. Tenants are not in a rush. There's no bidding wars, right? So it kind of skews the data in the short term.
Yeah, if anything, it almost flips that dynamic on its head, where instead of bidding wars, you have 300 units that hit the market at once about these landlords, and they have to undercut each other trying to compete for them. So it's almost like the opposite dynamic in that sense.
Yeah, exactly. And rentals are still moving, but again, they're more sluggish. Some are taking several months, especially if the seller or the landlords are a bit unrealistic in their pricing, or they need a certain price because they just completed on their very expensive condo to make ends meet. Those people are kind of feeling a little bit pressured for sure.
Yeah, that makes sense.
So we kind of chatted about sort of the short term, a lot of completions in the pipeline. But what do you see happening like 2+ years from now? Like, in the next couple of years, it looks like housing starts, condo starts, all of that stuff will likely be trending down, right? And how does that feed into the housing market beyond the next 18 months?
Yeah, great question. So I've been kind of pounding the table on this one point, which is that the supply picture for single family. I'm going to focus in on that segment first, and then I'll return back to your condos question.
Single family mean like low rise, detached, semi.
Anything low rise, detached, semi, correct. So single family, low rise. If you look at the building permits data, it's so scary, man. Like, it's so low. We're basically in Ontario, we're back to levels we haven't seen since the early 80s. In BC, we actually don't have precedent for how low single family permits are right now. So construction activity is already weak. It's going to get much weaker, which means that at some point, like, everything is cyclical. And people always forget that. People always think that when houses are going up, they're going to go up forever. And when you're in a weak market like it is today, it's going to be weak forever. Everything's cyclical. And at some point, demand is going to start to normalize. And I see like a serious potential issue around a shortage of single family, not this year, probably not next year, but beyond 26 and 27, I think you can see a real issue there. Now, that's single family, and that problem is already hitting.
Yeah.
On the condo side, you have to remember, like, it's a weird thing because there's such a lag in the development process between when the condos are pre-sold and when the units actually complete, right? It can be a 5-6 year gap.
Yeah.
And so what we know is, if you take new condo sales, so we're talking pre-construction, and you lag by 18 months, that's what housing starts are going to look like.
Mhm.
Okay, so if new condo sales boom, you can set your watch 18 months later, condo starts are going to boom.
Mhm.
Now, the reason that's important is starting in kind of the back half of 2022, we saw just like a steep decline in new condo sales. I mean, the new condo market is dead right now.
Mhm.
And so we're getting close to the point where you're going to see like a steep drop off in condo starts,
Mhm.
and it's going to be steep. So what that means is condo starts are going to drop off, but you've still got this big slug of condos that are in the construction pipeline. And so
Mhm.
it's going to take a while for them to finish, a couple years. But then there's going to be like nothing behind those in
Mhm.
terms of new supply. And so you can see a setup where even that segment of the market could end up in a deficit, but that's like a 27, 28 type story. And
Mhm.
in between now and then, I think we've got a pretty significant supply, like excess supply, let's say.
Mhm. Interesting. Now, what do you think's the barrier in some of these condo projects kind of not moving to purpose-built rental? Obviously, like the mom and pop investors kind of going to be dead for the next year and a half. The federal government's doing a lot of incentives, financial incentive to encourage purpose-built rental. Why do you think we're not seeing more people just roll their projects over into longer term rentals?
That's a great question. I'm probably not the right guy to answer that. I would assume probably some of that is that they've got agreements, they've got loan facilities, they have to achieve a certain price. You're probably not going to get that selling a purchase rental to a pension or something like that. You need them to be condos, you need them to close for that
Yeah.
to achieve it. That would be my guess. I don't know. You'd have to talk to somebody that's a little more plugged into the development side of things, but I would guess it has to do with the realized price of purpose built versus condo.
Interesting. Now, you kind of touched on something that I think is important. I mean, you talked about sort of this really soft volume of sales and starts and permits for low rise single family. Your report talked about, was it 20 people for every one single family start or permit or something like that?
Yeah.
How does that going to play out in pricing? Like, are we just going to see? I mean, obviously, that's probably going to set a floor on low rise just naturally, and then we just see more people moving out of province. Like again, we're kind of starting to see these dynamics where people are just saying, "I'm sick of this. I can't pay sort of GTA prices, not even Toronto prices." And you think that kind of shift is going to continue over the next few years because of this shortage of family-sized housing?
Yeah, I think you're bang on. And so maybe just to walk through a bit of that data for the
Sure.
viewers, if you look at the number of single family housing starts over the past 12 months, and you compare that to the number of people we've added to the population, we have added 20 people for every one new single family home that we've started to build. Unprecedented numbers. Now that's going to start to slow because we know the population growth is probably going to start falling pretty significantly. But the point is the damage has kind of been done. And if you
Mhm.
look at the building permits, which I discussed, which is forward looking, you need to get a permit before you can start construction. So it tells us where construction activity is going.
Mhm.
And the permit numbers look just abysmal. So we have a real shortage there. How this gets resolved, I think you're right. It argues that there probably is a bit of a floor under single family, but man, I don't know where that is, right? I mean,
Mhm.
it could be down, like it could be down 10, 20, like I don't know where it could be relative to here, or it could just be that prices kind of stay flat for
Mhm.
5, 6, 7 years, and
Yeah.
you sort of in real terms they fall. Um, I don't know, and the tricky thing is it doesn't feel like an undersupplied market because demand is so weak and it's so constrained by affordability.
Mhm.
Um, so this is not, like I said, this is not an issue for this year, not an issue for next year. I think probably this year and into early next year, the natural direction for pricing is probably going to be to grind lower,
Mhm.
barring something dramatic changing. But I do worry beyond that 27. Like I don't know when, but at some point demand is going to normalize, and there's no new supply, and
Mhm.
so yeah, you have to think that's going to put a floor under pricing. As to population flows, like that is one of the interesting things that we're seeing. And it's not new, but it's accelerating, which is that people are leaving Ontario for other provinces,
Mhm.
an insignificant size. And I think that this whole work from home dynamic plus affordability challenges means that you've seen a lot of people moving to Atlantic Canada, to the prairies, anywhere where there's more affordability. You're seeing like significant outflows from Ontario into those places. Now, that, just to be really clear, that's not saying the population of Ontario is falling, right? It's for people listening, because of course we have immigration, we still have people coming here, but for the people who live here already, you're seeing a net outflow of those people from Ontario into other provinces, and it's accelerating. So I think that's probably going to continue. It's one of the things that's going to help close some of the affordability arbitrage between, let's say a Calgary and a Toronto, where Calgary traded at kind of national average prices for most of the last 30 years and got just crazy cheap for a few years, and now is starting to kind of swing back up again. And I think that's going to continue.
Interesting. Now, since I have you mentioned something earlier, and I'll get your insight because I don't follow the BC market. What is driving the BC construction boom? Because I mean, Ontario is lagging, but it sounds like BC's kind of doing pretty well in terms of units under sort of construction. Is that mainly condos or rentals, or what's kind of driving that? And what's the difference, do you think, between here in Ontario or here in BC?
Yeah, so they've got a huge boom in in apartment rents, purpose-built rentals.
Okay.
To be clear, they didn't build anything from late 1980s onwards, and so there's some catch up there. But and there's also a lot of apartments, and typically half of the apartment units end up in the long-term rental pool when they complete. So I track what I call the de facto rental supply, which is rentals under construction plus half of the condo units under construction.
Yeah.
And it's very high in BC. And so, and especially if you compare it to the size of the current rental stock, it's very high. It's the highest in the country. And so that argues that that's an area where you could see rental dynamics shift the most, right? It could really swing. Here in Ontario and in Toronto in particular, it's not nearly as big, that kind of slug of dwellings under construction relative to the existing stock. So that's all it is. There's a lot of rentals. I probably don't have a great explanation for why it's surged the way that it has vis-a-vis Ontario, but it's quite an alarming chart. It looks like, well, not alarming is not the right word. It looks like a hockey stick. It's flat for the longest time, and it's spiked straight up in the last couple of years.
Interesting. So I wanted to wrap up with your thoughts on something that you've touched about, and we've kind of chatted a little bit on some of our other shows. This term called blanket appraisals. Maybe you can kind of unpack what that is, what that means for the condo market, and kind of some of the things that you've just seen at a high level or have kind of heard sort of, people's, murmuring and talking about.
Yeah, this is a tough one. I've tried to figure out how to really lay this out in a clean story for the media to kind of pick up and run with. And we're having challenges kind of unpacking it, because it is kind of this opaque dynamic that we're not really sure how to properly interpret. But to lay the foundation, the condos that are completing today were pre-sold 4 or 5 years ago, and so they entered into a commitment to buy 4 or 5 years ago. Now, over time, what we've seen is the premium that people were willing to pay to purchase in the pre-construction market relative to a new unit in the resale market was growing. And especially in kind of like the late 20 through to early 2022 period, you had this dynamic where you had condos that were selling even then for like 20-25% premium to resale. And so what that means is if resale prices were to stay flat, when those condo units come time to complete, they won't appraise for the price that the buyer is contractually obligated to pay. And that creates all sorts of issues. So for example, a unit might be completing today and the buyer has agreed to pay the developer $750,000. But in actuality, the resale market, if that same person were to sell that unit, would probably be something like $600,000, just to use some round numbers. Okay, so they're $150,000 underwater on that. Now, our concern for a while, and by the way, this dynamic gets worse, right? We're only starting to see these deeply underwater condo units starting to complete. It gets much worse in 25 and 26. And so this is only the tip of the spear on this problem. I had the view that this was going to be a real issue for these buyers to close, because what bank is going to say, yeah, we think this property is worth 800,000, even though you can only sell it for 600 today, right? No bank's going to do that, or so we
Mhm.
thought. And so we thought that could potentially create a dynamic where you had some distressed selling, where people had to walk away from their obligation. Instead, what we're finding, and it's not everywhere, but in some developments, we're seeing this thing called a blanket appraisal, where the banks are effectively saying, we will choose to appraise these units at the purchase price that you agreed to pay. So we will give you 80% of that purchase price, irrespective of what it would actually fetch in the resale market. So they've kind of said, like, we're just going to close our eyes and pretend that this unit is actually worth the 750 or whatever it might be,
Mhm.
and pretend that it's not in actuality worth 600. And because of that, that has allowed some some developments that we thought would be problematic
Mhm.
to close very easily.
Mhm.
And one in particular, you and I were discussing offline,
Mhm.
where I mean, it was known in the industry that these units are 20% offside relative to resale.
Mhm.
And that's been confirmed because since that development closed, we have seen at least one resale unit sell. And
Mhm.
it did indeed sell for a substantially lower price than the contractual sale price to the developer. So we know those
Yeah.
units are offside. Somehow all the buyers got financing, primarily with a particularly large blue bank seems to be
Mhm.
a major player in that space. So I don't know what it all means. I think at some point I think OSFI's going to have to chime in, because the implication is that banks are taking mortgages onto their balance sheet at potentially over 100% loan to value, right?
Yeah. So
100% of the fair market value, right? And
yeah.
OSFI at some point is going to have to answer to whether they feel comfortable with that practice.
So to unpack that, just so like people can really kind of wrap their heads around it, if we use your example, someone who bought a $750,000 condo, right? That's now worth only 600. Okay. In theory, maybe that buyer put down $150,000 in deposits for the pre-construction builder, right? But now when they're about to take possession, the bank comes in and says it's only worth 600,000. What should happen is that the bank says, well, it doesn't matter that you put a $150,000 deposit because you kind of lost that because the value went down 150 grand. So in theory, and correct me if I'm wrong, those buyers would need to come up with another 20% of the appraised value, which is say 600,000. So they'd have they have to come up with $120,000 cash, correct?
Yeah,
And
that's exactly right. That's correct. So basically, the banks should be saying this unit is worth 600,000. We'll give you 80% of that, which would
Mhm,
leave the buyer short that amount.
mhm. Exactly. And what we're talking about with this idea of blanket appraisals is not happening. This whole idea that they have to fork out this additional amount to take into account that the price went down isn't happening. The banks are kind of closing their eyes and say, well, it doesn't matter if it is worth only 600. We'll pretend it's really worth 750. So in that example, technically then that buyer has bought a condo with zero down, technically,
Right,
correct?
right. So yeah, I
Because
mean,
it
I know
doesn't.
they put they put a deposit down, but to frame it differently, um, maybe an easier way for people to understand it is the banks have now financed a condo at 100% loan to value on their balance sheet, because there
Exactly.
is no equity there in excess of the mortgage amount if you actually were to have to sell that unit. Now, that is 100% against the rules, especially on units that are uninsured, right? Where you really, they should have to put 20% down.
Exactly. Yeah. Mind blowing. So yeah, definitely something I'm probably going to write about a little bit further and unpack some of these, because I did look at that building and the cash flow numbers on those are mind blowing. And similar trends I saw, just all of these completions happening. It just doesn't make sense. We don't have all of the details, but you're right. Like, given the hundreds of units, the probability that not one person was distressed and had to sell is nil. There's something else going on. And I do think obviously these blanket appraisals are happening.
Yeah, and just to be really clear, I'm not saying it's a bad policy on the part of the bank, right? Because
Mhm.
you have to understand, for some of these banks, they may have a $200 million construction facility on the other side of this to that developer. Now, if all of the buyers were to walk away from that development and not close, all of a sudden that's a huge problem for the bank, because now they have a $200 million non-performing loan that they have to deal with. So I get the thinking. They're basically saying, we want to take a definite $200 million problem and turn it into a whole bunch of small potential problems, right?
Yeah.
And we'll deal with that down the road if they turn out to be problematic. So, like, I'm not saying it's the wrong decision for the banks to do that. I get why they're thinking that way. I would like to hear OSFI articulate how they feel about that.
Yeah, 100%. I mean, we get why and I think it's important for the viewer. I don't think this is about saving investors. Like, I don't think the banks are doing this. It's about kind of protecting the bank's investment, I suspect, more than anything. The bank who funded and financed that construction project. But, you know, at the end of the day, you know, it seems like our bank regulators, banking policies have an asterisk of them that basically say, well, now and again, we can kind of ignore them. You know, when it suits the bank's interest, we can just kind of ignore some of these policies. So, and obviously, OSFI, the bank regulator, has to know that this is going on and is kind of just closing their eyes to it, I suspect, is what's happening.
Well, it's a good question. I don't know how much they know what's going on. I'll tell you something interesting. When I started kind of banging the drum about this, I all of a sudden noticed that I got a whole bunch of people from OSFI follow me on LinkedIn and follow me on Twitter. And I actually messaged them. I was like, hey, what's going on over there? Because it was like, you know, media relations at OSFI. And they were like, wow, you know, your name keeps coming up in these daily briefings. And like, we just wanted to follow you to see what you were saying. So I don't know. I don't know if they are always as plugged in with kind of the day-to-day happenings at the banks as we might assume, but they have to be now. And I am curious to hear how they're going to address this growing phenomenon of these blanket appraisals.
Interesting. Well, Ben, thanks so much for taking the time. I don't know if there's anything else you wanted to add before we wrap up that I missed.
No, I think you nailed it, man. I think it was a good discussion.
Awesome. Well, thanks so much for taking the time to chat with us again this week.
Always a pleasure, John.